Now, energy companies are warning consumers that gas bills will rise and billions in investment could be driven out of New South Wales due to the state government's CSG regulation changes. So, is it worth buying or holding on to AGL and Origin now that New South Wales is cracking down on gas drilling? Joining me in the studio is Simon Bond from RBS Morgans and Roger Montgomery, the Chief Investment Officer of Montgomery Investment Management. Guys, thanks for joining us.
It's a pleasure. Nice to be here with Simon.
Yeah, for sure. Now, I've given the mining issues to Simon, and then you're going to look at
the reporting season.
Yeah, and the
good, the bad, and the ugly.
Okay, good. The good, the bad, and the ugly, which is like the team here. I won't say who's who.
I'm staying
I've been in trouble for that. We're a part of the team. All right, Simon, let's kick off with you. And this was stimulated by a reviewer who's actually said, I'm now worried about my energy stocks given the fact that Premier O'Farrell in New South Wales has basically said you can't drill within 2 k's of a residence and you can't drill within, is it 2 k's of a vineyard or a horse business or anything like that. And so a lot of companies, their plans may well be changed. So Roger was saying earlier, you were happy with the report for Origin?
No, I thought it was terrible.
Yeah. Yeah,
that's the opposite of what you just said.
Yeah.
No, it was a big miss.
Yeah, it was a big miss. Yeah, and I've been hesitating. Like Ron Bewley, he's a very good sector guest there on this program, said he thought infrastructure was a good place to be because it has been sort of ignored by the market. And I want to pick a good infrastructure company in there, and AGL and Origin to sort of they analyse. You don't like Origin. I'm a bit dicey on Origin.
But it's always been expensive too.
Yeah.
You know, I've never seen it at our intrinsic value or below it.
Yeah.
And that's because a lot of the buyers, natural buyers of these sorts of big infrastructure type stocks, tend to be long-term pension funds that are happy to get CPI returns plus 1% or 2%.
Yeah.
So they're not looking for the 13, 14, 15% gains that we're after.
Yeah.
And so they're happy to pay much higher prices.
Okay, let's go, Roger. You have a view on Woodside?
No, I don't, but I do want to talk very quickly about BHP. I know we've only got a minute or two.
Yeah.
But BHP's result came out, and as you know, it was down about 58%, and then Jack Nasser came out and said that the company is stronger and safer than it was 6 years ago when the outgoing CEO stepped in. And I thought I'd check that. I thought I'd go and check that. And it was interesting because they made the comment that they've handed $36 billion back to shareholders over the last 5 or 6 years. That's true. None of that's not true. But here's the thing. In 2006, the profit for BHP was $13.2 billion. This year it's forecast to be $13.8 billion. So you've had no growth in profit.
Yep.
But in that time, the equity that investors have contributed to that company through retained earnings, so the amount of money that they've entrusted to management over that time has gone up by about $30 billion. It's gone from $34 billion to about $32 billion to $64 billion. Well, the money you've taken, if you own that business outright, you've been given $36 billion and then you've put it back into the company and the profits haven't grown. And the other thing is the debt, the borrowings of the company have gone from $12 billion to $27 billion. So they've gone up $15 billion. So I would say, while maybe it's safer and maybe it's stronger, I would also argue that maybe it's not, and in fact it's far less profitable.
Roger, the issue around debt is a tricky one because if the debt's going to go in and produce fantastic returns that we're unable to guess now, well then it's good in debt, isn't it?
The classic managerial response is you borrow money when you can get a return that's greater than the cost of that money. So if you can generate a return that's greater than the cost of capital, you do it and you leverage up. Yeah. But there's got to be some natural limit to that because you can't borrow forever, irrespective of what the returns are that you can get. Because in the stock market, what tends to happen is there's quite an unnatural re-rating of stocks that have debt. So the PEs of companies with debt tend to actually be higher. But what happens is if they miss revenue or they miss at the EBIT level, or at the EBITDA level rather, then what you find is the magnitude of change on the downside to the share price is far greater because of the debt. Yeah. And we would need a screen and a whiteboard and I could explain it all, but that's the arithmetic.
But the interesting thing is that it's a $13 billion profit with very low coal and iron ore prices.
Well, you've got Richard coming in, he can talk about
coal. So if prices they have rebounded since that period, if that profit was $20 billion because of higher oil prices, would you be as worried about the debt then?
Well, no, of course, because the return on the equity and the return on the debt would be much better. Yeah. But the reality is, nobody's very good at forecasting commodity prices, and
nor the value of an investment in a certain mine and a shale gas investment in America hasn't been a good investment.
But commodity prices particularly are notoriously difficult to forecast, and so borrowing money against a development where you're digging something out of the ground, you don't know the price you're going to get, you don't know who you're going to sell it to, and you don't know when you're going to get it out of the ground. That's a risky proposition.
Let's talk. You brought up Richard, and you once weren't a fan of Wesfarmers because of their debt. Obviously, they borrowed for Coles and they've done very well with Coles. Does it temper your view? Because your job is to say, to put warning bells out if you don't like the
what you have to understand
signs.
is, shortly after that acquisition was announced, the shares were at over $40, and that's when I put out the warning. Now, they subsequently fell, and you could argue that they fell
to around 28, 29,
well, no, they fell lower than that, and you could argue that some of that fall was related to the global financial crisis, but the point was made that return on equity would drop, and return on equity still hasn't recovered significantly, and that remains an issue. And management has come out, and the chairman has come out and said, our job is to generate high returns on equity, and we've got to improve that. So that's where they're heading. That's what they've got to do.
Okay, but I guess the point I'm trying to make is that you have certain negatives and warning signs, and you say, I'm not prepared to take a punt. It doesn't mean that that company doesn't do well, does it? So
No.
for people who watch us here...
There's two parts to our methodology, and we've significantly outperformed the market following this approach. It doesn't mean that we get everything right, but following the approach, it works. And there's two parts to it. We want a quality business, and we want to be able to buy it cheap. We're bargain hunters. And if we can't get it cheap, or we see something ludicrously expensive, then I see it as part of my job to actually educate investors and explain to them why we're not participating in that current fad.
Great stuff.